Intermediate Accounting, Chapter 7, Cash and Receivables. Chapter 7, Cash and Receivables. After studying this chapter, you should be able to 1. Understand cash and accounts receivable from a business perspective. 2. Define financial assets and identify items that are considered cash and cash equivalents and how they are reported. 3. Define receivables and identify the different types of receivables from an accounting perspective. 4. Account for and explain the accounting issues related to the recognition and measurement of accounts receivable. 5. Account for and explain the accounting issues related to the impairment in value of accounts receivable. 6. Account for and explain the accounting issues related to the recognition and measurement of notes and loans receivable. 7. Account for and explain the basic accounting issues related to the derecognition of receivables. 8. Explain how receivables and loans are reported and analyzed. 9. Identify differences in accounting between IFRS and ASPE and what changes are expected in the near future. After studying Appendix 7A, you should be able to 10. Explain common techniques for controlling cash. Cash and receivables. Cash and receivables. Understanding cash and accounts receivable. How do companies manage and control cash? What types of companies have extensive accounts receivable? What are the types of accounts receivable? How do companies manage accounts receivable? Cash recognition and measurement. What is cash? Reporting cash. Summary of cash-related items. Receivables, recognition and measurement. Definition and types. Recognition and measurement of accounts receivable. Impairment of accounts receivable. Recognition and measurement of short-term notes and loans receivable. Recognition and measurement of long-term notes and loans receivable. And derecognition of receivables. Presentation, disclosure, and analysis of receivables. Presentation and disclosure analysis. IFRS ASPE comparison. A comparison of IFRS and ASPE looking ahead. Appendix 7A cash controls. Management and control of cash. Using bank accounts. The impressed petty cash system. Physical protection of cash balances. Recognition of bank balances. Understanding cash and accounts receivable. Key issues relating to management and control of cash include minimizing idle cash, cash flow budgets, internal controls including regular bank reconciliations. Key issues relating to management and control of accounts receivable include collectibility, credit policies, monitoring accounts receivable levels, and discounts. Financial asset. Any asset that is cash, a contractual right to receive cash or another financial asset from another party, a contractual right to exchange financial instruments with another party under conditions that are potentially favorable to the entity, or an equity instrument of another entity. And this is from the CPA Canada Handbook, Part 2, Section 3856. What is cash? One of two. Cash is considered to be a current asset if it is readily available to pay current obligations and is free of restrictions. Consists of coins, currency, available funds on deposit at the bank, and petty cash. Also includes money orders, certified checks, cashier's checks, personal checks, bank drafts, and usually savings accounts. What is cash? 2 of 2. Money market funds and certificates of deposit are cash equivalents. Post-dated checks and travel advances are not classified as cash. Reporting of cash. Some categories of cash need special attention with respect to reporting. Restricted cash, petty cash, special payroll, dividend bank accounts. If the restricted cash balance is material, it must be segregated from regular cash for reporting purposes. Classified as current or non-current assets depending on date of availability or expected disbursement. Restricted cash. Compensating balances. Minimum cash balances maintained by a corporation in support of existing borrowings, not available for use by the corporation, but the bank can use the restricted cash. Legally restricted balances must be reported separately, current or long-term assets or note disclosure. Foreign currencies. Amount held in foreign currencies is reported in Canadian dollars on the date of the statement. The exchange rate on the date of the statement of financial position is used to translate foreign currencies into Canadian dollars. If restrictions exist on the foreign funds, those funds are reported as restricted. Bank overdrafts. Overdrafts occur when checks are written in excess of the cash account balance. Overdrafts are reported as current liabilities, often reported as accounts payable. In general, bank overdrafts should not be offset against the cash account. However, bank overdrafts may be offset against available cash in another account if both accounts are at the same bank. Cash equivalents. Defined as short-term, highly liquid investments that are readily convertible to known amounts of cash and which are subject to an insignificant risk of changes in value. Original maturity is generally 3 months or less. Typical examples are treasury bills, money market funds, and commercial paper. ASPE excludes equity securities, but under IFRS, some equity instruments can be classified as cash equivalents. For example, preferred shares acquired within a short time of their maturity date. Cash equivalents are reported at fair value. Accounts receivable, one of two. In general, accounts receivable are claims that a company has against customers and others, usually for specific cash receipts in the future. Current or short-term and non-current long-term. Trade receivables are amounts owed by customers as a result of sales from ordinary operations. Accounts receivable, a verbal promise to pay normally within 30 to 60 days. Notes receivable are written promises with specified terms, example, interest rate and due date. Accounts receivable, two of two. Non-trade receivables include the following: advances to employees or other officers, delayed payment terms from a purchaser, receivables from the government, for example, GST recoverable, income tax receivable, dividends and interest receivable, amounts owing by insurance companies, loans receivable or notes receivable, investments in government debt, corporate bonds, convertible debt, and commercial paper are not receivables because they are held for trade. Accounts receivable recognition and measurement standards. 1. Recognize an accounts receivable when the entity becomes a party to the contractual provisions of the financial instrument. 2. Recognize the receivable at the fair market value subject to discounts and the interest element. 3. Adjust receivables to amortize cost. Accounts receivable recognition. Recognize an accounts receivable when the entity becomes a party to the contractual provisions of the financial instrument. When one of the parties to the transaction has performed as per the agreement between the two parties. Similar to the way revenue is recognized in Chapter 6. When a sale is recognized, cash is received or an accounts receivable is recognized. Accounts receivable measurement. Measure the receivable initially at its fair value. Trade discounts, net amount. Cash or sales discounts, 2% if it's paid within 10 days, or net 30. Sales returns and price allowances after the fact. Time allowed to settle the account, generally ignored. Adjust receivables to amortize cost. Receivables with an interest component. Impairment of accounts receivable. Recognize the impact of impairment or uncollectibility. Loans and receivables are impaired if there is significant adverse change in expected configuration of cash flows, that is, timing or amount. Impaired trade accounts receivable are called bad debts or uncollectible accounts. Under IFRS, the loss allowance is based on lifetime expected credit losses. Ensuring that a reasonable estimate is made of the amount of the accounts receivable that is unlikely to be collected. Estimating uncollectible accounts 1 of 4. Short-term receivables are reported at their net realizable value. Requires estimating the accounts or the amounts that are expected to be uncollectible. Adjustments to the allowance account on the statement of financial position also impact the income statement through bad debts expense. Methods for estimating the allowance. The allowance method, the percentage of receivables method, or the percentage of sales method. Estimating uncollectible accounts 2 of 4 allowance approach. Management analyzes accounts receivable at the end of every month and estimates the uncollectible accounts. Allowance account is adjusted to the correct balance. Balance already in the allowance account must be considered. Bad debt expense is adjusted to balance the entry. Estimating uncollectible accounts 3 of 4, percentage of receivables approach. Using past experience, management estimates the percentage of outstanding receivables that will be uncollectible with an aging schedule. Allowance account is correct at period end. Balance already in the allowance account must be considered. Offset is recorded as bad debt expense. Does not focus on matching bad debt expense to sales. Estimating uncollectible accounts 4 of 4, percentage of sales approach. At month end, management estimate the bad debt expense as a percentage of current month's sales. Matches the estimated cost of bad debts to sales generated in the same accounting period. Existing balance in the allowance for doubtful accounts is initially ignored. Accounts receivable will not reflect net realizable value. At year end, receivables have to be analyzed to ensure the balance in the allowance account is correct. Accounts receivable aging schedule. Wilson and Company aging schedule. Age, number of days accounts are outstanding. So you have the list of customer names, then you have the total balance at December 31st, and then you have them segregated by under 61 days, then 61 to 90 days, then 91 to 120 days, and then over 120 days. Allowance method 1 of 4. Example 7.3. Prepare an analysis to estimate uncollectible amounts for Wilson and Company. So we have each of the amounts, then we have the percentage estimated to be uncollectible, which is usually given to us by management, and then we multiply that by the amount to get our estimate of uncollectible accounts. And you add all of those up from the 61 days, 61 to 90, 91 to 120, and over 120. And then that gives you the year-end balance for your allowance for doubtful accounts. And that's what it should equal. So in our case, it's 37650. Allowance method 2 of 4. Balance sheet presentation. Example 7.4a. Show how Wilson and Company would reflect the estimated uncollectible amount on its statement of financial position using the allowance method. So we have Wilson and Company's statement of financial position as at December 31st. We have our current assets for our total accounts receivable of 547,000 less the allowance for doubtful accounts of 37650 for the net amount of 509,350. Allowance method 3 of 4. Journal entry credit balance. Example 7.4b. Assume the allowance account already had a credit balance of 18800 before adjustment. What journal entry would Wilson & Co. prepare? So you would debit bad debt expense for 18850 and credit allowance for doubtful accounts for 18850. And so then when you total the amount in your T account, you'll have the 37650. So you're doing the offset adjustment, not adjusting for the balance. Allowance Method 404, Journal Entry Debit Balance. Example 7.4b. Assume the allowance account already had a debit balance of $200 before adjustment. What journal entry would Wilson and Company prepare? Then you would debit bad debt expense for 37850 and credit allowance for doubtful accounts of 37850. So again, what we're doing is journalizing the offset, so then our balance in our allowance for doubtful accounts is the 37650 credit. Combining methods 1 of 2, percentage of sales approach. Example 7.5a. Dockrell Corp estimates 2% of every month's net credit sales will be uncollectible. What journal entries would be required during the year if net credit sales are $400,000 annually? You would debit bad debt expense for $8,000 and credit allowance for doubtful accounts for $8,000, so it's just the 2% times the $400,000. Combining methods 2 of 2, percentage of sales approach. Example 7.6. Management estimates the uncollectible accounts at year-end are $9,900. What journal entry should Dockrell make if the balance in the allowance for doubtful accounts is $7,500 before adjustments? So you would debit bad debt expense for $2,400 and credit allowance for doubtful accounts for $2,400. Remember, you're doing the offset adjustments, which is the $2,400. Allowance method, writing off accounts receivable. When a specific customer's account is determined to be uncollectible, the following entry is made: debit allowance for doubtful accounts and credit accounts receivable. If payment is received after write-off of account, the account is reinstated and payment is recorded. Debit accounts receivable, credit allowance for doubtful accounts. Debit cash and credit accounts receivable. Direct write-off method. Record bad debt expense only when a specific account is determined to be uncollectible. Debit bad debt expense and credit accounts receivable. No allowance account is used. If amounts are collected for accounts previously written off, you debit cash and credit uncollectible accounts recovered. Recognition of short-term notes receivable. Notes receivable differ from accounts receivable as they are supported by a promissory note with specific terms. All notes contain some interest element and maturity date. Short-term notes mature within 1 year. Notes are either interest-bearing, have a stated rate of interest, or zero interest-bearing or non-interest-bearing. Interest amount is the difference between the amount borrowed and the face value. Interest-bearing short-term notes receivable. Example 7.7. On March 14th, an accounts receivable of $1,000 is exchanged for a 6% 6-month note. What journal entries would Prime Corporation make to record the substitution and payment of the note? On March 14th, you would debit notes receivable for $1,000 and credit accounts receivable for $1,000. On September 14th, you would credit cash for $1,030, you would debit cash for $1,030. You would credit notes receivable for $1,000, and then you would credit interest income for $30. So that would be 1,000 times 6%, and then multiply that by 6/12, and that's in months. Non-interest-bearing short-term notes receivable, example 7.8. On February 23rd, a $5,000 9-month non-interest-bearing note is issued. 8% is the implied interest rate. So February 23rd, you would record the notes receivable at 4717 and credit cash for 4717. On November 23rd, you would debit cash for $5,000, credit notes receivable for $4,717, and credit interest income for $283. So that would be the $4,717 times 8% multiplied by 9 months over 12. So we always record our notes receivable at present value. Long-term notes and loans receivable, 1 of 11. Long-term notes and loans receivable are recognized at fair value, that is the present value of the future cash flows. Face rate is the stated interest rate. Effective interest rate, PV discount rate. If interest rate equals market rate, fair value equals face value. If interest rate or market rate, loan is issued at a premium or a discount, and it's amortized, so if it's greater or less than. IFRS requires effective interest rate method of amortization, and ASPE does not specify. Long-term notes and loans receivable, 2 of 11. Interest-bearing notes issued at face value. Example 7.9. Assume that Biglow Corp lends Scandinavian Imports $10,000 in exchange for a $10,000 3-year note bearing interest at 10% payable annually. The market rate of interest for a note of similar risk is also 10%. Long-term notes and loans receivable, interest-bearing notes issued at face value. Example 7.9. And what we'll be doing is using our calculators to calculate the present value. So in this case, the face value of the note is $10,000. The present value of the lump sum principal is $7,513. The present value of the ordinary interest annuity is $2,487. So the present value of the note is $10,000. The difference is 0. Long-term notes and loans receivable. Interest-bearing notes issued at face value. Example 7.9. Journal entry to record the issue and also to record annual interest. You would debit notes receivable for $10,000 and credit cash for $10,000 on the issuance of the note. And you would debit cash for $1,000 and credit interest income for $1,000, which is $10,000 times 10%, which is the interest for a full year. Long-term notes and loans receivable, 5 of 11. Notes issued at 0 interest bearing. Jeremiah Company receives a 3-year, $10,000, 0 interest bearing note, and the present value is known to be 772180. So the implicit interest rate is 9%. And again, we will use our financial calculators in order to calculate that when we go through problems in class. So the interest component will equal 2278.20. Long-term notes and loans receivable, 6 of 11. Notes issued at 0 interest bearing. Example 7.11. Record journal entry for first year using effective interest rate method for amortization. So you would debit the notes receivable for $694.96 and you would credit interest income for $694.96. So your present value, your current present value is $7,721.8. Long-term notes and loans receivable. Notes issued at 0 interest bearing. Example 7.12. Compare straight line and effective interest rate methods years 1 and 2. So if you decide to record the interest using straight line method, it's just the same as the depreciation straight line method. So year 1 you would do debit notes receivable for $759.4 and credit interest income for $759.4. And if we use the effective interest rate method, you have to use the present value. So you would debit $694.96 and credit interest income for $694.96. Then in year 2, you would have the same journal entry under the straight line method where you would debit notes receivable for $759.4 and credit interest income for $759.4. Then under the effective interest rate method, you would debit notes receivable for $757.51 and credit interest income for $757.51. Long-term notes and loans receivable 8 of 11. Interest-bearing notes at a discount. Assume that Morgan Corp makes a loan to Marie Co. and receives in exchange a $10,000 3-year note bearing interest at 10% annually, but the market rate of interest for a note of similar risk is 12%. So if we use our financial calculator, we will calculate the present value to be 9520. So the difference is the interest of $480. Long-term notes and loans receivable 9 of 11. Interest-bearing notes at a discount, effective interest. $10,000 note at 10% for 3 years. Market rate is higher at 12%. The present value is the $95.20 and the discount is $480. The interest receivable at the stated rate of interest is $1,000 and the first year amortization is $1,142. So we would record debit notes receivable for $95.20, so we always debit for the present value, and credit cash for $95.20, and then we would debit cash for $1,000, debit notes receivable for $142, and credit the interest income for $1,142. Long-term notes and loans receivable 10 of 11. Interest-bearing notes at a discount, straight line. So in this case, you would debit notes receivable for $95.20 and credit cash for $95.20, and you would debit cash for $1,000, debit notes receivable for $160, and credit interest income for $1,160. So you would take the $480 divided by 3, which is the discount, and add $1,000 to get the $1,160 for your straight line. Long-term notes and loans receivable 11 of 11. Interest-bearing notes at a premium. Stated rate of interest is higher than the effective rate of interest. Note is issued at a premium. Present value of the note at issuance will be higher than the face value. Note is recorded at the higher value. Excess is amortized by crediting notes receivable and debiting interest income. Notes for property, goods, or services. The issue is determining the selling price. Depends on the market rate. Known. Use it to determine present value of future cash flows discounted at the market rate. Unknown. Use the fair value of the property, goods, and services to estimate the value. Use an imputed or estimated interest rate. Required to record effective interest income and amortize the discount. Derecognition of a receivable. The holder of accounts or notes receivable may transfer them to another company for cash. The transfer may be a secured borrowing. Holder retains ownership of receivables. The receivables are used as collateral. A sale of receivables. Holder transfers ownership of receivables in a sale. Factoring. Transfer major risks and rewards. Securitization. Interests in financial assets are sold to a third party. Secured borrowing. Account for receivable, now collateralized, same way as before secured borrowing. Collect the accounts receivable, record sales returns and sales discounts, absorb bad debts expense. Account for new liability, example note payable. Record a finance charge if applicable. Record interest expense on note payable. Receivables are not derecognized. Sale of receivables. Factoring. Purchaser buys the receivables for a fee and then collects directly from the customer. Usually involves only one other company. Purchaser assumes risk of collection and absorbs any losses without recourse. Seller does not service the receivables. Derecognition. Seller credits accounts receivable for face value. Seller records gain or loss on sale of receivables. With recourse, purchaser does not have the risk of collection, not treated as a sale, under IFRS 9. Securitization. Securitization. Interest and financial assets are sold to a third party. Transfer receivables through securities, debt and equity, backed by a pool of financial assets. Many investors are involved. Seller continues to service the receivables. Under IFRS, Seller must continue to recognize the receivables. Significant disclosures. Underlying principles. Is it a sale or is it secured borrowing? Sale of receivables, derecognition. Secured borrowing, no derecognition, additional liability. Criteria for determining classification. Substantially all the risks and rewards have been transferred under IFRS. Transferee controls if and when the assets can be sold to a third party, ASPE. Borrowing versus sale treatment, IFRS 9. Have the contractual rights to receive cash flow been transferred? No. Does the entity have an obligation to pay cash flows receipts? No. Then you record the transaction as secured borrowings. If yes, does the entity have no obligation to pay amounts to the recipient unless collected from original receivables? Is the entity prohibited from selling or pledging the original assets? Does the entity have an obligation to remit cash flows collected on behalf of the recipient without significant delay? Then you would record the transaction as a sale. So if you have the contractual rights to receive cash flow being transferred, and the answer is yes, then you would automatically record the transaction as a sale. Accounting for transfers of receivables, ASPE. Transfer of receivables. Has the transfer surrendered control? In other words, does it meet these three conditions? Transferred assets are isolated from transferor. Transferee has the right to pledge or sell the assets. Transferor does not maintain control through a repurchase agreement. If the answer is no, you record as secured borrowings. 1, record the liability, and then 2, record the interest expense. If the answer is yes, and if there is continuing involvement, then you would record as a sale. You use the financial components approach. 1, reduce the receivables. 2, recognize the component assets obtained and liabilities incurred. 3, record the gain or loss. If the answer is no, then you record as a sale. 1, reduce the receivables, and 2, record the gain or loss. Presentation of trade accounts and notes receivable, 1 of 2. Reporting and disclosures required by IFRS. Segregate types of receivables. If greater than 1 year, report amount at maturity date. Separate current from non-current receivables. Use an allowance account to record impairments. IFRS also requires a reconciliation of changes in the allowance account during the accounting period. Income statement disclosure of interest income, impairment losses, and any reversal of such losses. Requirements under ASPE are less stringent. Presentation of trade accounts and notes receivable, 2 of 2. Detailed disclosure about securitization or transfer of receivables, whether derecognized or not, risk exposure, credit risk with loans and receivables, fair value information about loans and receivables. Far less about risk exposure and fair values under ASPE. Analysis. Accounts receivable turnover equals net sales divided by revenue divided by average trade receivable net. Measures the number of times, on average, receivables are collected during the period. Provides information about the quality of the receivables. Shows how successfully the company collects its outstanding receivables. Compare with prior periods, industry standards, the company's credit terms, or internal targets. Comparison, IFRS, cash and cash equivalents, allows preferred shares acquired close to maturity date. ASPE does not allow equities to be considered cash. Recognition and measurement of receivable IFRS requires use of the effective interest rate method for recognizing interest income and amortization. Under ASPE, you can use either the effective interest method or the straight line method. Derecognition considers whether substantial risks and rewards of ownership have been transferred. Under ASPE, considers who has control of the asset. Disclosures requires detailed quantitative and qualitative disclosures. ASPE requires basic disclosures. Looking ahead, IASB and FASB are working to simplify aspects of the accounting for and reporting of financial instruments, including a new model for impairments.